Nela, I don't know how much of our initial conversation at the top of the show you caught from Milan. We're gutted you're in Milan, but we're glad you're on the show. We want you here. But just tell us what, just if you may, before we go into other nuances about the US economy, what do you think about the dollar and the historical perspective from various administrations? Karen and I are desperate to hear your thoughts.
Well, I think what you both in your comments have underlined is the uncertainty of the policy right now. And that uncertainty has marked the dollar markets, at times the bond markets, and certainly the uncertainty spills into the Fed decision today and the response to that Fed decision. So if you capture the US economy, if you knew nothing about the last year, but just saw the headline numbers, the unemployment rate, which is low, the third quarter GDP growth rate, which is high, productivity, high, you would capture a very strong US economy that would suggest a stronger dollar and an interest rate policy that was not going lower. But that is not where we find ourselves today. And I think what your comments reflect is the uncertainty of this moment.
That is a great point, Nela, isn't it? I think the market's trying to put together the policy initiatives and approach we've had from the Trump administration, the independence question from the Fed, which of course impacts the safety of the US dollar, the tariff uncertainty that we've had, and this interest rate call that interest rates should be much lower from here from the White House. I think the market's putting that together with the comments that Trump made that didn't really suggest much about a weak dollar. What is the consequence of a weak dollar from here? What do you think that does for the US economy if it continues in this vein in 2026?
I think you've captured it. I mean, a weak dollar is kind of a double-edged sword, right? A weak dollar does make U.S. exports more competitive abroad, but a weak dollar at home doesn't always have the confidence of markets. And that confidence is going to be very important as we look at other things that are a struggle for the U.S. economy, like sticky inflation, like high deficits and debts, and the need to sell treasuries both domestically and abroad. And so this puzzle of the U.S. economy has become increasingly complex. The headline numbers, as I mentioned earlier, don't tell the whole story. And that dollar weakness is a sign of the fraying of that story, even though the headline numbers objectively are strong.
Nela, the most interesting, frustrating element here could be sticky inflation. The hawks were concerned about it last year. There are fears that the tariff impact could still be filtering through. And as we talk about a weak dollar, that could also thwart the ability of US consumers to see cheaper prices. So if that is the case, and we're looking at a 2026 where the president is still trying to decide his pick to be the next Fed chair because he wants someone who's going to be leaning towards lower interest rates, what is the potential for sticky inflation to get in the way here?
You know, sticky inflation is something I think was always going to be a struggle, and I think it's going to be important. It's not just the inflation levels now; it's the accumulation of inflation over the last 3 to 5 years, which is double the pace that Americans are used to seeing. So, you know, consumers, they don't look at inflation rates, they look at price levels, and those are not going down. And so you hear on the streets of the United States this question of affordability. So even though inflation has gone down quite a bit, it's still not at the Federal Reserve target. And what consumers are responding to is the cumulative effect of inflation over the past few years.
Nela, let's get back to your wheelhouse as well. When I look at, well, there's all your wheelhouse, to be fair, but the jobs market as well. GDP now, 5.4%. It's a great figure. Productivity numbers, the most recent, were a great figure. The unemployment rate of 4.4% is not a disturbing figure. So why are we all so worried about consumer confidence and the data being absolutely awful last time round? Consumer confidence collapsing to its weakest level in more than a decade. Just tell me what's going on beneath the surface in the jobs market, Nela.
I can tell you in a letter, it's K. It's a K-shaped consumer spending pattern where the top 20% of income earners are driving most of the spending in the United States, and the lower quartile of consumers are struggling over the higher pace of inflation. The numbers look good, but underneath the surface is where all the action is. And even if you look at the labor market is reflecting that K-shaped consumer, where we're seeing hiring in healthcare services, which are expensive services in the United States for most consumers, and leisure and hospitality, which is a discretionary service for all consumers. So if you are well heeled, this economy is great for you. If you are not, it's a struggle.
What does it mean for interest rates, Nela? There are a lot of detractors in and outside of the administration who do think the Federal Reserve is too slow. If 80% of America, you mentioned quartile, I think there's a couple of quartiles in there that are struggling on. I think the downward leg of the K is pretty fat. And I'd agree with you about the disparity in the US economy. Is the Fed moving too slowly then, given the fact that a lot of Americans, again, whatever quartile it is, are absolutely suffering at the moment despite the great headline figures?
Traditionally, the Fed has moved slow, deliberately, modestly, and moderately. And so what we've seen over the last few years, when you see a 50 basis point move in either direction, that has been the outlier. I think what's the struggle for the Fed is that they are confronting things that are structural, not cyclical. There are structural changes to the US labor market, which are being reflected, that the Fed has no ability to adjust. They live in a short-term world. They work with short-term bonds, not long-lived. And what we're seeing is demographic change and productivity changes that are affecting the structural US labor market. And so that is a fiscal policy concern, but we are always looking to the Fed to kind of drive the monetary policy. Unfortunately, the structural parts is not in their bandwidth.
Nela, I want to pick up on those points around the job market and what's coming. The boss of Manpower last week saying, look, AI is not disrupting the labour market at scale yet. The CEO of Anthropic saying, look, an unusual, painful short-term shock is coming to the labour market. How do we think about bracing for impact around AI?
Yeah, that's a great question. I spent a lot of time last week in Davos discussing that question. I think AI's impact is not going to be seen at a high level in the labor market. In fact, we have to think about AI's impact actually affecting what we do in a day, not necessarily the jobs that are created, at least in the short term. But our own research with Stanford University shows that AI is having an impact in some careers, especially early career, young people. And in the United States, it is taking longer for young college educated workers to find jobs. Now, whether that's all AI or if that harkens back to these structural changes in the labor market I mentioned, it's too soon to tell. But there is some impact that we can actually measure. And so it's important to engage early career and young people in this labor market. Those are the ones that look to be most vulnerable right now.
So, Nela, if I can piece that together, it sounds like you don't think there's a massive shock coming. In fact, it's going to be productivity gains, which sounds positive for the stock market, positive for the US economy.
You know, I think that the US economy is strong in terms of the macro detail. And I think one of the reasons it's strong is because of this K-shaped economy in which wealthy consumers continue to spend and AI investment that has elevated the stock market. My concerns, though, is this is a highly concentrated US economy. The job gains are concentrated in two sectors. Broadly speaking, we are not seeing hiring growth. My concern is in the stock market. It is highly concentrated in 7 tech stocks. We're not seeing the kind of broad gains that I would like to see in the equity markets. And so the narrowing of wealth creation in the United States is a concern because it makes us more vulnerable to the shocks that you mentioned.
Nela, we started off the show and you were observing Karen and I's conversation about the president's supposed indifference maybe to a weaker dollar and the ramifications. We've got Scott Bessent on the channel later on as well. We're also obviously going to hear from the Fed chair as well. Do you think we're at the stage yet where policy members or administration members are actually going to have to start defending the dollar?
I don't think so yet, though. If the dollar slide continues, I think that's going to be a real concern. Right now, it's early on in the, and I think a weak dollar has been a concern for several months now. But unless it becomes an ongoing factor in U.S. competitiveness, I don't know if those comments will be necessitated by current economic conditions, which are overall solid. However, I have not been a great predictor of public comment recently, especially by the administration or policymakers. So I'm going to reserve the right to be incorrect on this and what will be commented on later today.
And Nela, we heard last week that we might be getting close to knowing who the next head of the Federal Reserve would be. It could be this week, but it seems like there's still a lot of pondering. Trump has 4 candidates from Hassett to Walsh, Waller and Ryder, but it sounds like none of them are perfect. What's the market weighing up as the perfect candidate of the 4 that have been served up?
The market seems to shift. I think what's popular this week and what's popular last week often doesn't match up. I think the 4 candidates have been at times front runners. Each one of them have been front runners. I think overall, though, what the markets really yearn for is an independent Fed.